How did the richest economy in the world collapse almost overnight? Picture this. It's the 1920s, and an entire nation is dancing to the frantic, exhilarating rhythm of jazz. Wealth seems absolutely limitless. The champagne is flowing, and ordinary people are watching their bank accounts swell to unimaginable heights. But then, almost in the blink of an eye, the music completely stops. The champagne is replaced by endless breadlines. Massive fortunes literally evaporate into thin air, and millions of families are plunged into the most severe economic downturn in modern human history. Welcome to our explainer on the Great Depression. Today, we're going to unpack the incredible true story of how a soaring era of prosperity turned into a devastating decade of desperation that completely reshaped the entire world.
Okay, let's dive into this. It's the central mystery we are going to unravel today. How exactly did the richest, most vibrant economy on the planet collapse so swiftly and so entirely? Was it just a terrible run of bad luck, or was there a fundamental, deeply hidden flaw in the very foundation of the financial system itself? Well, to understand the brutal crash, we first have to understand the incredible, intoxicating high that preceded it.
Part 1. The Roaring Twenties Bubble. Let's rewind to the year 1918. World War I has just ended and American soldiers are returning home victorious. Now, during the war, women had entered the workforce in massive numbers. And with the men returning, the economy just absolutely exploded into a spectacular post-war boom. A huge cultural shift took hold. But the real revolution? That was happening right on the factory floor. Over in Detroit, Henry Ford revolutionized transportation with the moving assembly line. Before this, cars were strictly luxury items for the super rich. But mass production dropped the price of a Ford Model T from $780 in 1910 to a mere $290 by 1924. It became the first truly inexpensive car for the masses. By 1927, the 15 millionth Model T rolled out of the factory. It was a game changer. Other companies immediately copied this assembly line process, churning out radios, washing machines, and vacuums. But here's the kicker. To fuel this incredible, ravenous demand, banks began giving out loans freely. People were buying all these new products on credit, using money they didn't actually have. The age of debt-fueled consumerism was officially born. Naturally, all that consumer spending sent corporate profits straight through the roof, and the stock market responded. From 1921 to 1929, the U.S. stock market didn't just grow, it skyrocketed, increasing sixfold. Wall Street became the absolute center of the universe. As the general public learned about these incredible, almost guaranteed returns, a massive snowball effect took hold. Everyone, from bankers to shoeshine boys, began pouring their life savings into stocks. It's a classic historical trap. When everyday people start believing that no price is too high for a stock, it's a glaring warning sign. It tells us that prices are no longer based on the reality of the underlying businesses. They are driven by extreme greed and completely irrational exuberance.
So, the absolutely crucial point here is how people were actually buying these stocks. They weren't just taking cash out of their piggy banks, they were heavily using something called margin trading. Essentially, this meant you could buy stocks by paying only 10 to 40% of the actual stock price up front, and then you just take out a loan from a stockbroker for the rest. The idea was incredibly seductive. When the stock inevitably went up, you simply sold it, paid off the loan, and kept the massive profits for yourself. It sounds like a brilliant, foolproof plan, right? Well, it is, until things suddenly go south. By 1929, an absolutely staggering 40% of all U.S. consumer debt was being used purely to purchase stocks. The entire market was essentially built on borrowed money.
And this brings us to a moment that perfectly illustrates the supreme, almost blinding overconfidence of the era. Just as 40% of the entire nation's debt is precariously tied up in a massive speculative bubble, newly elected President Herbert Hoover delivers this wildly optimistic quote in 1929. He proudly proclaims that America is nearing the final triumph over poverty. To the general public, the skyrocketing stock market was undeniable proof of a permanently booming economy. But just under the surface, trouble was brewing. Global trade was stalling out, Europe was still heavily recovering from the devastation of the war, and simply couldn't afford to buy American goods anymore. The fantastic illusion was about to shatter into a million pieces.
Part 2. The Great Crash of 1929. This was the exact moment gravity finally caught up with the market. The jazz music stopped cold. The euphoria completely vanished, and it was instantly replaced by sheer, unadulterated panic. Catastrophe struck on October 24, 1929, a day that will forever live in infamy as Black Thursday. The market saw terrifyingly heavy liquidation. A record 12.9 million shares were furiously sold off, and the entire market plummeted by 11% in a single day. But the bleeding didn't stop there. The following week brought the legendary Black Tuesday. The market fell another 12%, with a mind-boggling, record-breaking 16.4 million shares sold. In the incredibly short span of just 2 weeks, stocks lost about a third of their total value. Remember all those millions of people buying on margin? They were instantly, brutally crushed. Brokers immediately demanded their loaned money back, and regular, everyday citizens literally lost their entire life savings overnight.
Part 3. The banking system collapsed.
Now, there is a very common misconception that the stock market crash directly caused the Great Depression. But actually, that crash merely triggered a severe recession. What really turned it into a deeply devastating, decade-long depression was a total systemic failure of the banks. You see, at this time, many U.S. banks were small, independent mom-and-pop shops. And they had recklessly lent out massive amounts of their depositors' money to people for stock market speculation. When the crash hit, all those loans instantly went bad. What followed was the terrifying psychology of a bank run. Let's look at a specific case in New York City. A single, entirely false rumor started circulating that the Bank of the United States had refused to sell a man's stock. That one tiny rumor sparked a massive, uncontrollable panic. Over 25,000 terrified people crowded the bank in a single day, desperately withdrawing $3 million in cash. Completely unable to handle that kind of rapid drain, the bank was forced to close its doors permanently. That single failure accounted for a third of the total $550 million in deposits lost during the early stages of the Depression.
This specific event sent massive shockwaves across the entire country. You really have to remember, there was absolutely no deposit insurance back then, no federal guarantees. If your local bank closed down, your money was just gone. Poof, vanished. Headlines of bank closures created a deadly contagion of fear. Panicking citizens rushed to pull their savings out of everywhere, even from perfectly healthy, responsible banks. Ultimately, a staggering 33%, that's 1/3 of all banks in America, completely failed during this period. Over 9,000 banking institutions simply ceased to exist.
Because people were justifiably terrified, they stopped trusting the banking system entirely. They actually started hoarding their physical cash under mattresses, burying it in coffee cans, and hiding it in floorboards. This massive behavioral shift led to a devastating 31% decline in the total U.S. money supply between 1929 and 1933. Basically, the money just stopped flowing. And through all of this cascading disaster, the Federal Reserve stood back and essentially did nothing. They strictly adhered to the economic theories of the time and allowed the money supply contraction and the banking failures to just happen, without any major intervention. It was a crucial, widely criticized mistake that modern economists universally agree made the Depression much, much worse than it ever needed to be.
Part 4. Deflation and human tragedy.
With a full third of the money supply simply vanishing from circulation, a deadly, almost unstoppable economic force was unleashed upon the country: deflation. Now, on the surface, deflation actually sounds like a pretty good thing at first glance, right? Prices go down, things get cheaper, but the actual reality is a vicious, fiercely destructive cycle. Because the value of money is actively going up, consumers delay their spending. They think, why buy this today if it'll be cheaper next week? This massive lack of consumer spending destroys business revenue. When businesses aren't making money, they completely stop investing, they start aggressively slashing wages, and they have to fire their workers. To make matters even worse, if you happen to owe a fixed amount of debt, say for a family mortgage or a farm loan, that debt suddenly becomes significantly heavier and harder to carry, precisely because your personal income has just plummeted. It's an economic death spiral. Meanwhile, down in Washington, President Hoover was desperately trying to protect American farmers and domestic industries from cheap foreign competition. But he made a truly disastrous miscalculation. He signed the Smoot-Hawley Tariff Act in 1930, which brutally increased tariffs on foreign imports by about 20%. So what happened? Exactly what you'd expect. 25 different countries immediately retaliated, furiously slapping their own harsh tariffs right back on American goods. As a direct result, global trade plummeted by an astonishing 66% worldwide between 1929 and 1934. In a misguided attempt to protect the domestic economy, these isolationist policies effectively strangled the global economy to death.
And we really must pause to ground these massive macroeconomic numbers in the sheer unimaginable human tragedy that unfolded. The Dow Jones Industrial Average eventually fell 90% from its peak. 9 million personal savings accounts were entirely, completely wiped out. Unemployment reached an agonizing 24.9%, which remains the absolute highest in American history. 34 million people were left without any reliable source of income whatsoever. Sprawling shanty towns, bitterly nicknamed Hoovervilles by the public, sprang up across the country as homelessness just exploded. And to make a terrible situation exponentially worse, a massive, prolonged drought combined with years of terrible farming practices caused the Dust Bowl right in the middle of the US. It was the worst man-made ecological disaster in American history. With a third of all Americans still working directly in agriculture at the time, the daily suffering was absolute and inescapable.
Part 5. Recovery and Economic Lessons.
The American people were utterly desperate for a lifeline, and in 1932, the political landscape shifted dramatically. Franklin D. Roosevelt was elected president by a landslide, promising drastic, immediate action and a new deal to pull the country out of the abyss. What's truly fascinating as an economic historian is looking at how his administration systematically targeted the exact structural flaws that caused the crisis in the first place. To stop the rampant bank runs and restore public trust, FDR enacted the FDIC, finally providing federal insurance on everyday bank deposits. To prevent the wild, completely unregulated speculation that caused the stock market bubble, he created the Securities and Exchange Commission, or the SEC. And to combat the severe, crushing poverty and total lack of a social safety net, he pushed through a minimum wage, mandatory overtime pay, unemployment insurance, and the landmark Social Security program. While they didn't fix the economy overnight, these specific programs successfully stabilized the bleeding banking industry and finally began restoring the public's shattered confidence.
However, it's incredibly important to note that while the New Deal certainly stabilized the bleeding and provided essential relief, it took several more years for the underlying economy to fully bounce back. The Great Depression had spread violently across the globe, devastating Europe, Asia, and Latin America, which tragically paved the way for the rise of extremist governments abroad. Ultimately, it wasn't actually until the start of World War II in 1939 that the Great Depression truly ended. The immense, unprecedented government stimulus required to fund and support the global war effort massively boosted American industrial production. Factories were suddenly running 24/7, and it was really only then that the unemployment rate finally, definitively fell back below 10%.
So what do we actually take away from all this? Economists still passionately debate the exact nuances, but the core lessons from the Great Depression absolutely form the bedrock of our modern financial system today. For one, we learned the crucial need for central banks to maintain a small, stable amount of inflation to encourage healthy spending and investment, desperately avoiding that deadly death spiral of deflation we talked about. We also learned the vital stabilizing role of government intervention and strategic assistance during a severe recession, rather than stubbornly standing back and doing nothing. And perhaps most importantly for us as investors, we learned how to identify dangerous, extremely over-leveraged market bubbles that are driven purely by irrational greed. When literally everyone around you is telling you that prices can only go up, history tells us loud and clear to be very, very careful.
Which brings us to our final thought for today. The Great Depression is a profound, incredibly sobering reminder of the twin forces that constantly drive our global economies: unbridled greed and contagious fear. Just like all historical bubbles, an artificially overinflated market almost always sees the exact same ending of a painful, devastating crash. The Great Depression reminds us that markets can rise on optimism, but they can also fall on fear. The greatest investment is not chasing quick profits, but understanding history. Thank you for joining me for this explainer. I hope it gave you a whole new perspective on exactly what happened when the Roaring Twenties finally ran out of gas.